There's a competitive bidding auction going on for Warner Brothers and HBO. Netflix are trying to bid for them, and the bidding is up to about $75 billion so far.
If Netflix manages to secure Warner Brothers, it will be the death of Hollywood.
We mean that longer maturity bonds are much higher than shorter dated bonds. If you were to draw a line or a curve, it would be quite upward sloping from left, shorter dated bonds, to right at the longer maturities.
Elon Musk's SpaceX is going to float, and the valuation is being pushed up or touted around as $1.5 trillion. That would make Elon Musk the first trillionaire on the planet.
It's a big week next week. There's people endangering this Santa rally. We've got ECB rate decision, Bank of England rate decision, Bank of Japan, non-farm payrolls, CPI, inflation. It's meant to be Christmas spice. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 23 of The Art of Investing, voted the country's #1 financial podcast and brought to you by IG, the global investment platform. Now, introducing my co-conspirators. This week, it is the chairman, Chris CJ Fellingham.
Morning, Rich.
And then his longtime partner in crime, our equities expert, the eternally ebullient Mark Spice Holden.
Wow, I don't even understand that word, but I'll take it.
It's got bull in it, so that'll give you a clue. That could be taken two ways as well, CJ.
I'm leaving that today. It's Christmas. That's
it's going to be
nice.
one of those episodes.
And we welcome back our top economist, Stu Thompson, with us for the second time.
Hi, thanks.
Right, good stuff. As always, let's move on then to the Spice Market Update. We've got a lot to get through today, so very much looking forward to this.
Thanks very much, Rich. Well, for the first time in about a month, I've been able to say that crypto's pretty stable this week, actually. I think, by all, sort of measures, Bitcoin is virtually unchanged from this time last week, which I think is a miracle. But more interest, though, we've had a bit of movement in some of the bond yields. We've seen sort of bond yields in America move up about 10 basis points, or 0.1% for our listeners, and the same in Japan as well. And that's despite the Federal Reserve last night meeting, that's Wednesday night, meeting and cutting interest rates as expected by 25 basis points, or 0.25%. So that was welcomed by the markets at first, and that took the brakes off the Santa sleigh that had been put on the week before. But that was quickly then spoilt by our friends Oracle. If you remember, Oracle it's probably the most volatile stock we've looked at in the last few months. Back in September, they rose 40% in one day, if you remember, the biggest ever move, as they did a deal with OpenAI to sort of build data centers and supply them with their computing needs. And yesterday they had the results, and the results only just met forecasts. And in this sort of market, when markets have gone up as much as they have, that's just not good enough, unfortunately. So the market was pretty punishing because they didn't like the fact that their capital expenditure, which I know is one of Rich's bugbears about AI, was outstripping revenues quite substantially by more than expected. So yeah, they were talking about massive order books going forward, even better than they expected, but they're getting no revenue in, or not enough revenue in, to stop their debt rising faster than they expected. And so the shares are down 11% as I looked this morning. And that's had a bit of a negative drag on what was a good result for the markets yesterday after the Federal Reserve cutting. So that's had a bit of an offset today. Interestingly, though, with not just Oracle, but there's some of these big companies we know have come off their best. So companies like NVIDIA and even Microsoft and co have come off their best. But there has been some rotation. We've highlighted this before. So I can say for the first time in a while, the Russell 2000 hit a new all-time high last night. That's the first time we've had an equity market high for a few weeks, actually. Yeah. Silver hit another all-time high, is really racing very, very strongly.
Which we don't have, Spice, is that right?
Well, we've got some in the BlackRock World Mining,
which
we had to remind the chairman about that.
We can talk about buying copper last week if we want and losing money on that. If we really want to go to these things,
you're so short term.
The fact is, in the BlackRock World Mining Trust, there's loads of exposure to silver. So that's why I bought more of it. If you remember.
In company land, there's a couple of other things that are worth highlighting. The first is that there's a competitive bidding auction going on for Warner Brothers and HBO. So Netflix are trying to bid for them, as are Paramount, Skydance. So those of you who use streaming services, you'll realise that they're obviously two major players. And the bidding is up to about $75 billion so far. And the gloves are still off, so it's expected to rise probably another, 20 or 30% from there, up to about 100 billion.
It was quite interesting as well. The CEO of Paramount, who came in to try and trump Netflix's bid. Is that still the right term? I don't know if we use that anymore.
I think there's lots of links.
Yeah. He stated that if Netflix manages to secure Warner Brothers, it will be the death of Hollywood. But there is a little bit of an angle here because the CEO of Paramount happens to be the son of Larry Ellison, who owns Oracle. So there is some kind of argument that perhaps Ellison and Trump may step in and say that the combination of Netflix and Warner Brothers would be anti-competitive, and therefore Paramount will end up with the deal.
Oh, but that would make me think there was a conspiracy going on somewhere. That can't happen, can it? In proper markets these days? That doesn't happen anymore, does it?
Trump couldn't keep out of it. I mean, last night I noticed on the news wires that he said that if the deal goes ahead, CNN, who are owned obviously by Warner Brothers, HBO, will have to be spun out because he believes they don't sort of report news fairly. Funny enough, they're quite anti-Trump, I believe, in their sort of editorials.
That's fake news.
So the other thing about all this, and I know you would bring this up, but I'll mention it to start with, is that for those who've got a bit more of a bearish view on life, not anybody around this table anymore, for those who are a little bit bearish and who've got a long memory, will remember the fact that these sorts of takeovers happened towards the highs of markets. And in particular with Warner Brothers, you had AOL Time Warner back in the 2000. In 2000, sorry.
March 2000.
And other action around Warner. So you've got a massive competitive bidding going on, lots of new money being, I'll do this much, I'll do this much, and I'll do this much, around a stock that has traditionally marked the high. So for us, we need to hope that the bidding process continues for a few more months yet.
Yes.
Well, maybe the high is going to come in the middle of next year sometime, because I don't know if you picked up, but there is speculation that Elon Musk's SpaceX is going to float next year. And the rumor is that it'll be in the middle of next year, maybe the beginning of the second half. And the valuation is being pushed up or touted around as $1.5 trillion for this company. And that would make Elon Musk the first trillionaire on the planet if that came to pass, because he owns, in voting rights, about 75% of the company. And in sort of ordinary shares, I think about nearly half of them. But either way, I mean, he's already clearly a very wealthy man, and he would become even more wealthy. That would make him the first trillionaire on the planet. I mean, it's really interesting that they're starting to talk about how SpaceX could potentially build data centers in space, and because you can use the sun's power to power all these data centers, which we know are hugely sort of energy consumptive, and because you're in space, it's acts as cooling, a natural cooling to the system as well. So this is the theory they're pushing out there. If they get people to believe that, then it's another leg up in the AI.
I was going to say,
right up into the sky.
It's different this time. Ding, 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 ding.
There's a lot of very toppy sounding stories this week, isn't there?
I'm not focusing on these things because it'll mean that Christmas is spoiled worrying about what's going to happen. So at the moment, we'll just file them away in the need to be revisited box.
Yeah. I mean, other stuff in AI. Actually, one of our positions, India, are benefiting this week because Amazon and Microsoft have announced that they're going to invest $52 billion in India in AI data centers, funny enough. And that's despite obviously the massive tariffs that the US have imposed on India, and we know has been weighing on that market. It's had a bit of a better week. It's been a flat week for us this week, as we'll see in the report when we come to look at performance. But the main event really is the Federal Reserve, and this time next week we'll know what the bank will be close to knowing what the Bank of England are going to do. As I said last week, they're expect there's a 90% probability that they're going to cut by 0.25%. That probability has stayed the same this week. But I think we need to talk about the Federal Reserve, which is the main event of the week.
I think that it was a really important meeting yesterday, and has opened up a number of things that we could talk about and consider. Not just the leadership of the Fed going forward and how that's going to be settled, but you've also had what's called the dot plots. And for those who are new to this or who are still learning the lingo, the dot plots are where the members of the Federal Reserve Board put a dot down to show where they think growth, inflation, interest rates will be at various times. And I think most of the time people focus on is at the end of next year sort of thing. And so people look at how that has been done now compared to how it was done in the last meeting or the meeting before. And they hope to therefore see how the members of the board are changing their views on interest rates. And I think one of the things that's quite interesting is that now, you'll remember from previous discussions when we've talked about the Fed, there were times they were pricing in 5 or 6 rate cuts. Now, we've had a couple of those now, but there's only one more priced in now. So I think I said at the time that 5 or 6 was too aggressive, and actually we've only now pricing in 3. Clearly there's a chance we're still going to get those, and the bull across from me will say it's just a pause at the moment. But it's interesting how that's where things are. There was a big variety as well, but I'm going to start in one place. And the place I'm going to start is something else they did last night, which I think was even more important. Now, we talked on this podcast about QE and QT. Now, QE is quantitative easing. Stu, one sentence on QE.
So QE is addition of liquidity. The central bank buys government bonds to push liquidity into the system.
Right, and QT
is taking that liquidity out of the system.
Okay, so we've been in a place since the COVID crisis where we had massive amount of QE, massive money pumped into the system, and over the last year, that money's been taken out by QT.
I actually remember recording a teaching video on this, sat in a jacuzzi in the sunshine in New Zealand. And the jacuzzi is the best example of QE and QT because the level of water is simply the money supply or the amount of liquidity around. When you turn the taps on, then that's QE. You're putting more liquidity in there. Everybody's happy. And then when the party finishes, you have to pull the plug at the bottom and let that water drain out. And that is quantitative tightening.
So what did they do yesterday? They started doing QE again at the front end of the bond market. So in what's called treasury bills. Now, treasury bills are US bonds which have a maturity of 1 year or less. So these are really short-dated bonds, and they're used by the banks in all sorts of financing. Now, we're not going to get into the technicals of it here. Finance has been getting much more difficult for the banks, and you've seen that in that some of these yields at the front end of the market in these bills have gone a bit higher, which isn't what they want. They want them lower. When they cut interest rates, they want these things down. So the Federal Reserve have started to print money again and buy these bills. Now, I would argue the reason why the stock market went up yesterday evening was that. It was nothing to do with the fact they cut rates. That was all priced in.
Yeah.
And there was no change in how bonds were priced after that. But what they weren't expecting was such an aggressive move. Now, we've got to ask ourselves, why did they make such an aggressive move? Does the Fed know something that we don't? I'm sure they do, let's be honest. Let's answer that question easily. Or is there something else going on? But that was, to me, a really important part of what happened yesterday.
Yeah, so the market expected them to announce this in March, and they expected the monthly rate to be about 20 billion. It was double that, and we got it 3 months early.
So I think that's very, very interesting. But what about some of the other things they did as well, guys? What else did they do that we need to note?
Well, I totally agree with you that the reintroduction of QE rather than QT was a positive for equity markets. But so too was the fact that they've actually upped their growth forecasts for 2026 in the US for gross domestic product, as it's called. That was nudged higher. And that's because they're seeing more efficiencies and productivity gains coming from AI. And they actually specifically mentioned the AI in the conference.
Is that the first time they've really mentioned AI?
Yeah, really. And they were talking, they mentioned it in passing as well when they were talking about unemployment in the US, because one of the reasons they were able to cut yesterday, if you remember, the Federal Reserve have two mandates, or they have several mandates. One is to try and get growth going in the economy. One is to try and control inflation. And the other one is to try and maintain full employment, or try to get as much employment as possible in the economy. And because we know in the last few months, unemployment has been rising in the United States, albeit marginally, they were saying that part of that is due to AI. And companies are not bringing on as many new people, and they're laying off people at the margin. And we're seeing this rise in youth unemployment that is specifically really related to AI. So they pointed to the fact that actually, although there has been positive growth in jobs, in theory, at the margin, about 40,000 new payrolls each month, they think that actually the real number is actually minus 20. So they think it's been overstated by 60,000. So as a result, they feel comfortable that they, as part of their mandate, they have to try and meet that employment side. And that's why they cut yesterday. And they've sort of said that, they expect that to continue for a while yet.
And at last, we get some employment data next Tuesday. So Tuesday, 1:30 p.m. is going to be a big opportunity for us to catch up with what this real economic data, isn't it, Stuart?
Yes, and I think what we'll see is weak employment growth, because I agree with the Fed. I think that for the last couple of years, the employment numbers have been overstated. The difficulty, of course, is that you're looking at the marginal monthly change after seasonal adjustment on roughly 150 million people. So there's no result on a monthly basis that is statistically significant. And so there's a big margin for error. The numbers are frequently revised. We had a massive downward revision earlier this year to the past numbers because the models that they were using were overstated because they're based around what they estimate to be the productivity number. Obviously, that productivity number is improving, which is good for growth, but not great for workers. It's not great for employment. And with the Fed's dual mandate, they have to be cognizant of that.
Yeah, it was a massive overstatement. It was something like 800,000, which was huge.
Yeah.
But let's return to reality rather than getting into the bullish froth that sometimes takes over.
Bullish.
At the end of the day, they're only saying one more cut in 26.
Well, that's what the median got. That's what the median got.
And there's variety around that, but that means higher ones as well as lower ones. So what it says to me is there's massive uncertainty and it's unlikely to be settled soon. So anybody can basically make whatever case they like as to whether the rates are going to go up or rates are going to go down. More importantly, aside from that, is the new Federal Reserve chairman who's going to be appointed in May. And what do we know about that now?
The front runner is Kevin Hassett. And he is very close to Trump, and he is very much in the Trump camp of lowering interest rates. And, that means steeper yield curves for the market.
Okay, so just for everybody who's listening in, if you remember, we talked about yields at the short end of the market, so very short maturity bonds and very long maturity bonds. And when we say steeper, we mean that longer maturity bonds are much higher than shorter dated bonds. If you were to draw a line or a curve, it would be quite upward sloping from left, shorter dated bonds, to right at the longer maturities. And what that means is that's good for the financial sector because they borrow short, lend long, which is good. But it means if you want to refinance your mortgage or something like that, your mortgage rates will be higher because those longer bond yields are higher.
Investors demanding a higher risk premium to lend longer term.
And so we have gone from relatively flat, haven't we, to more like a hillside. If we get towards a mountain, that's when people start to worry, including financial markets, isn't it?
Well, I think, we're leading into the detail of what's going on in the engine room of the financial markets, which is clearly the bond market, as I would say, because I'm a bond guy, right? At the end of the day, over the last 3 weeks and for the last 4 weeks, bond yields around the world at the longer end have started picking up. Over the last 2 or 3 weeks, more sharply. And you would expect that when you cut interest rates, the very short-dated bonds would do well, and that would influence the longer bonds as well to do a little bit better as well. They're not. They're selling off.
And so you're talking the short end, 3 months?
3 month to 5 year bonds, you should expect to be influenced by that cut in interest rates this time round.
So they go down.
So they should go down a little bit because interest rates are lower. But the longer dated bonds are saying, hold on a minute, I'm not sure this is very sensible. I'm not sure that getting somebody in to cut interest rates aggressively, this new Fed chair, is good news. I think that might be inflationary. So I'm going to sell off those longer dated bonds because I think over time, interest rates will have to go up to combat inflation. So the curve is starting to get quite steep, as Stewie said, and there's a warning sign there. We're not yet at a level where you would say, gosh, this is a problem, but this is something we're going to have to watch over the next few weeks because I personally think this is going to become a problem sometime in the first half of the year.
Get 5% back on your investments. Open a new account and invest a minimum of £50 by the 31st of December and keep at least £50 invested until March. You'll get 5% on your invested value from 21st of November until the 31st of December. Your capital is at risk. New customers only. Offer valid until the 31st of December on ISA, GIA and SIP accounts. Maximum payout £100. Terms and conditions apply. Just a reminder, CJ, so you're talking about the 20 years and 30-year maturities.
Yes.
And why are they so important? What is that saying about the health of an economy in the long term?
Well, the buyers of those 20, 30-year bonds, first of all, are insurance companies, are pension funds, and they're looking to see, is the yield I'm getting a good compensation for the risk I'm taking? Let's take a stupid example. Silly example here for everybody listening. If we suddenly thought interest rates were going to go to 10% and stay up there because inflation was a real problem, why would you buy a bond yielding 5%? It'd be ridiculous. You would just keep your money in cash and keep yielding 10% and sit in that position. So you're only going to buy those long bonds when they reflect the likely move in interest rates and where inflation is and where you think monetary policy is going to go.
And of course, the bond price comes down and lower and lower and lower until the yield reflects.
Until the yield gets to a level where people want to buy it, and we go back to when Stewie first came here, the competition for capital argument, which is you could put your money anywhere you like in the world. Where do you buy an asset? While I can buy equities, which may not yield a lot, but go up quite a bit, I might as well buy equities rather than buy bonds at 5%. So maybe bonds have got to go to 6%, or maybe bonds have got to go to 7%. And as they go higher, they suck money out of other asset classes. So that's why everyone wants to control the long end of their bond market, because the long end of the bond market sets effectively the price of all other securities. And so that's why we've got to be careful here. At the moment, it's not a problem, but it's noticeable that at a time when they cut rates yesterday, they're doing a bit of QE, a lot of liquidity around, the long ends are saying, don't really like this very much.
See, it was really interesting because Jay Powell was asked about that in the press conference yesterday. And I'm one of those boring people. I listened to the whole press conference.
You and me both, Spice.
Yeah, exactly. But he actually said specifically, he said bond yields may be rising due to higher growth expectations. And, the other thing he said that inflation, on the other hand, should be coming lower because he thinks that by this time next year, the tariff impacts will have dropped out. And so that's why they expect inflation to be coming down towards their 2% target, remember, they have at the moment, even though they're forecasting it'll still be around 2.6% by this time next year. But that's down coming down slowly.
He also admitted that the numbers were fudged slightly because the government shutdown had cost them 0.2% this year. So you had to add that into next year. So it was inflated unrealistically next year.
So various people are not telling us quite the whole story, I see.
Well,
isn't that amazing?
Growth is growth.
But
and equities love growth.
And so my point is, on that, I don't care why bond yields are going up. It's not relevant. What's relevant is if they go up, it's a competition for capital. And when it gets to a level where people say, I don't want to buy my equities expecting an 8-10% return, let's say, with a risk of whatever, when I can buy a government bond at this yield and I can sleep soundly at night, and people all start buying government bonds, they don't buy equities. So this is the problem. While bonds, we've said this on many times on this podcast, and I stick to this all the time. As long as bonds stay well behaved, risk assets are absolutely fine. And I love risk assets, and we're all in there, and that's brilliant. So the things you've got to watch is when bonds are not behaving themselves. And all I'm saying is over the last few weeks, there's a little sign they may be misbehaving. We won't know really whether they are until a bit more unfold.
So people that want to keep this on their radar, which long bonds should they particularly look at? Because you can go CNBC bonds and it's got the rate there live. Which one? Is it US? Is it Japan? Is it UK?
Well, I mean, we'll all have different views of what is most important. To me, the US 10-year and the US 30-year are the things that I would look at. Another very important rate is the Japanese 10-year, because the Japanese are the savers of the world, and they've used all their savings to fund everybody else's deficits for many, many years. If they start bringing their money home, we better watch out. So you watch what happens there as well. So if, in my view, you don't want to focus on a whole load of these things. That's what I did all my life, and look how sad that's made me.
You said it.
Yeah. What you want to look at is the US market, really, 10 and 30 years, passing look at Japan from time to time. Biggest market in the world is the US. It's the clearing price for risk-free capital. Therefore, that's what you would look at.
Okay, but people watching back in 12 months' time, they'll say, God, they actually spotted what was going to happen. The 30-year at the moment about 4.6%, 4.7%.
It is a little higher than that. To me, it got up towards just over 5, and it's 5 where I start to worry. At the moment, we've been sitting around nicely in this range. It's moved towards the middle to starting the top third of the range, so it's not frightening yet. But if it starts hitting the top level, then I think we need to be thinking very carefully. There's a loss of credibility somewhere.
Remember, equity guys tend to look for the 10-year government bond yield. And in America at the moment, that's 4.15%. So, and that's up about 0.1% from last week. So that, as I said at the beginning of the market review, we've seen this small nudge up in bond yields. So prices have gone down. Yields have gone up marginally. That's happened in the US, and by about the same amount in Japan in the 10-year government bond there. So the 10-year government bond in Japan is now yielding 1.97%, which is nearly 2%. I can't remember the last time it was 2%. Stuart, you probably can remember
2007.
that. Was it 2007? So just before the financial crisis.
Oh, no.
Oh, my goodness. Why did I say that? Why did I say that?
It's different this time.
Anyway, I mean, that's why the Japanese are going to put rates up next week. The markets are anticipating that.
It's a big week next week. There's people endangering this Santa rally. We've got ECB rate decision, Bank of England rate decision, Bank of Japan, non-farm payrolls, CPI inflation. It's meant to be Christmas spice.
Oh, yeah. Once that's out of the way, you can really put the accelerator down, can't you?
It would be fair to say that Santa's rally has been a little bit delayed. One of our harshest critics rang me up yesterday and said, where's this Santa rally then? So, I pointed out that we're up 10%, but we'll come to that in a moment. But at the end of the day, I've been disappointed by the fact markets haven't moved ahead more. And all these other factors are just starting to make me think, still with it, but I'm starting. There's a little bit of negativity coming into my thinking.
Nothing goes in straight lines, CJ. You know that?
I think that takes us perfectly onto the portfolio, does it? Because you mentioned there, it starts with double digits. So total portfolio returns since inception now sitting just below 11%. A good week, gents, up 1.15%. Spice, where's that come from?
It's really come from 2 positions that we have. You all know how volatile, and we've cringed a few times and we've cheered a few times because the VanEck crypto and blockchain innovators exchange traded fund, ETF, has had another very good week. Is up over 7%, 7.2%, and we've got 5% in that. So it added about 0.35 sort of percent to our overall performance. But actually, the one that just nudged it to the top spot was the BlackRock World Mining Trust. It had a very good week last week as well. And that was up a similar amount, 7.2%. But we have 10% in that particular product. So we're up 0.7% just on that alone. So those two together made up 1%, just over 1% of the 1.15 we made on the whole week. All the other positions were neither here nor there. We didn't really have any big losses. Ironically, copper was our biggest loss. We're down 0.9% on the week. And the FTSE 250 was down 0.7%, which, by the way, we had obviously halved our position after the disappointing budget because we obviously had no catalyst to make the FTSE 250 in the UK do well. But actually, the only other thing that did really well, which is ironically, the UK small and mid caps, which is the mid 250, did badly this week. But in America, the best performing equity market, and I mentioned it earlier on, was the Russell 2000, which is up 1.5%. And that is really quite a massive differentiator between what's going on in the US and the UK. And that's partly obviously because we know there's growth is expected to start picking up in the US next year, interest rates coming down, tax cuts, all the rest of it should play into the small and mid-sized companies in the US. And of course, the UK budget was not stimulative. And that was disappointing. And that's what's hurting the UK small companies. But for the moment, we're seeing this rotation out of the bigger companies into some of the smaller companies in the US. And that's helped our position there. We've got 5% in the Russell.
Spice, your explanation there reminded me of a question we've got from Christine. And she asked a couple of things, but one of the things she really wanted to focus on was when we talked about value investing, I think it was last week, we talked about you need a catalyst to get things moving. We talked about how you get these value traps where you buy something and it sits there and never moves, and that's a bad place to be. What you want to be doing is identifying where value is, but then trying to identify what that catalyst is that moves it. And the question is, you all talked about value investing, but also needing a catalyst. Is there anywhere we can find catalysts easily?
Good question.
Easy is a very difficult thing, actually, ironically. But just in stocks and shares, there are a couple of catalysts that always come to mind to me. One is if management change. So if you change the chief executive or the finance director, then that can quite often sort of cause a change in direction of the business and a reinvigoration of the business quite often, or the opposite. Can't always be a good catalyst. It can also be a bad catalyst. Or if a business decide to sell a problem part of their organization and get rid of an area that's been dragging down the whole group by getting rid of it or closing it. Well, and that can also be a catalyst. So that's in stocks and shares are the main things I would look at there. In terms of markets, funny enough, we probably had a catalyst last night in the Federal Reserve by going from quantitative tightening, QT, as we talked about at the early part in the market review, to the quantitative easing. That is a catalyst because that is a change that we weren't identifying. We would have loved to have seen that and seen it and been ahead of it because the markets reacted very well last night. They got knocked back after the close because Oracle had their results. But the point was that there was a catalyst that changed there. So it might be a change of government. Like in Japan, we had a new lady prime minister in Japan who came in as the new Mrs. Thatcher in Japan, as you know. And she's come in and she's wanted to be more stimulative for the Japanese economy, pushing more stimulus in, £100 billion of new stimulus going into the economy. So that's a catalyst. Those are the sort of things, stimulus and a negative catalyst might be putting taxes up unexpectedly like they do in the UK.
That's a great example there of the budget where we then sold half our FTSE 250 because there was a negative catalyst. It wasn't as positive as we would like to have been. And so we moved there and took action on that.
This was my job for 3 years at Brevin Howard. The way I operated my book was to look for a catalyst 1 month out, right? So at the moment, it would be, how are all the professional investment analysts going to come back in January, and what are they going to be doing in their books? How are they going to be updating their models? So I would put a position on 2 weeks before a catalyst, or if it's a strategy day, right? Now, I think a good example is Diageo. Diageo has been a disaster, and suddenly they're getting this fantastic CEO coming in, but he's not coming in until January, which means there's every chance he does another profit warning in January. You know, the kitchen sink it, we call it in
Clear the
world.
What does that mean, Rich, for people who aren't aware what kitchen sinking means?
If you're a brand new CEO, you've had nothing to do with the company before, you come in, you find all the skeletons in the closet, and you bring all the expectations as low as possible, which usually includes some kind of profit warning, doesn't it? And then you've got a great head start. Then you announce a strategy day 4 months later, once you've had the time to come up with your strategy. So I'm just worried, a little bit worried in a stock like Diageo at the moment. The catalyst probably 4 months away. So then you try and hold back a little bit. But that's this identifying a catalyst, and it might be economic figures, it might be a Fed meeting, or sometimes it comes out as a surprise, identifying it 1 month out and then starting to position yourself 2 weeks beforehand, before everybody starts talking about it.
Great question. Thank you for that, Christine.
Now, this portfolio of ours, I hear the chairman's remarks every week. I hear the bull's remarks every week. I try and keep us a little bit cautious. I want to hear the real expert's view, the economist. Stu, what do you think of our...
What a setup that is.
Indeed.
No pressure.
Looking at this portfolio, it's done tremendously well. For me, as a cautious Scot, I would be pulling back a bit, particularly with my views in 2026, which you'll hear later. I would be buying more gilts, the 0 to 5 year area, because I think that gives you that safety in the risk-free asset. We do have a decent amount in your portfolio, but it can always have more gilts.
Spoken like a true Scotsman.
What's the one thing there that you would reduce, that you wouldn't be comfortable with? You wouldn't sleep at night, Stu?
Well, it tends to be the riskier side of things. You're very well exposed to the US. Now, I think we're peak Trump. Next year is going to be a more difficult year for Trump. I think next year is going to be a more difficult year for AI. I think we're going to see rising yields, greater competition for capital. So I would pull back on those, on the NASDAQ.
Okay, so just to confirm then, no changes to the portfolio, but perhaps a little risk warning there from our consultant, Stu Thompson. If you want to hear more of what Stu has to say on his outlook for 2026, including, did I just hear, peak Trump? So join us for our 2026 year outlook special released on the 2nd of January, wherever you get your podcasts. If you've got a question for us, then you know where to send it, gents.
Art of Investing at IG.com.
We'll see you next week for a Christmas special. We might have a couple of bottles of wine on the table.